Hello and welcome to the DIY Investing YouTube channel. We are doing quick dives on companies today. This is a 5-minute stock due diligence on a stock. And today we are talking about TIGO. This is Millicom International Cellular S.A. And we're going to dive into the quality of this business and the valuation. So let's get started. What I do first when I want to look at a company is I look at the business description. What kind of company is this? So we hear that this is in the wireless telecom communication services. I heard about this company on a podcast, so I have listened to about an hour podcast already about it, but it intrigued me enough to want to research it. So this would be the first 5 minutes of my research on the company. So we're doing this live. Well, it provides cable and mobile services in Latin America and Africa. Okay, they offer mobile services, mobile data, voice. This sounds just like any telecommunications company you'd have in the U.S. Money transfers, remittances, savings, loans, a little bit of banking services it feels like. So we have broadband, fixed voice, and pay TV. And then we have cloud services and a few other things. So you have quite a lot of stuff here. In the United States, this is what would be a pretty good business, fairly capital intensive. And so we'll see if that holds true for the Latin America and Africa markets as we dive forward. But that's how I'm framing it at first. I like to look at the beta of the companies I invest in, and I'm looking for a beta under 1. This is the lower the beta, the better in terms of the volatility. And 0.76 is relatively high, but it's below 1, and so that's a good sign. And then share turnover, I like to see less than 50%. So 22% is a good share turnover. That means that we're having relatively longer-term shareholders. So the most important thing I'd look at next is return on invested capital. So as we look at return on invested capital, I immediately see red flags here. So in 2001, 2002, you have negative returns, and then as it progresses, you bounce all over the place. 16%, 4%, 0%, 8, 26, 14, 20, 34, and it's just all over the place. So most recently we had 32% in 2014, but since 2014 it's been terrible. So 2015 is -6, and then -0, 1, -0, 1, -3. So the most recent year, -3%. Negative returns on capital is a really bad sign for a business. So I'm immediately feeling very negative on this, regardless of what this type of business might look like in the United States. This chart alone would cause me not to invest. But let's continue. Maybe we'll see something that's surprising. So key statistics is where I go next. Again, I'm using quickfns.net. This is where you can get a quick snapshot on a company. I like to see 10-year median returns. So return on assets, 1%. Return on equity, 4%. Return on invested capital, 1.4%. All of these numbers are bad. Any one of these numbers would probably disqualify the company for me. All three of them, again, just affirming this is not a company I would invest in. I want a return on assets above 10%, ideally. Return on equity, somewhere in the range of 10 to 20%, ideally over 15%. And a return on invested capital in that same ballpark. So let's look at valuation. As we see negative for PE, so this number probably doesn't mean anything, but you have EV to EBITDA of 4.8. That could be cheap. That seems relatively cheap. Price to book of 1.3, price to sales of 0.6. These are all attractive, but price to earnings, maybe they're losing money. So let's see. We have earnings per share, $8 in 2011. Bouncing all over the place. So you lost money in 2020, but you made $1.48 in 2019. So what's the current stock price? 27.23. So by 2019 prices, you're at like a PE of 15, 20, a PE of about 20. If you assume that 2019 is a regular number, but it's not, you have numbers all over the place. So again, just so far, I would not invest in this company. The only thing that could redeem something like this would be relatively good growth. And if we look at the 10-year Krager on growth, we have revenue of 0.6, so terrible. Asset growth exceeding revenue growth, big red flag. And then negative free cash flow growth. Again, because the current negative number, that's all kind of bonkers. So it's not really reliable. But not a stable company. You see stuff bouncing all over the place. The only positive I see here is that you had a stable dividend of $2.64 from 2013 to 2019. However, that's its own red flag because the EPS couldn't support it. So something weird is going on here. This company does not seem like something I would invest in. So that would be my 5 minutes. I'm not going to even go to the income statement and balance sheet because it just does not pass my first pass based upon this analysis. So although I enjoyed the podcast episode I listened to on TIGO, I would not invest, and this would be a pass in just the first 5 minutes. Thank you for listening. Don't forget to subscribe to the YouTube channel to get more videos like this, and hit that like button and share it with your friends. Thank you.